Picture this scenario, because it is a calculation we have all done at 2 a.m. on a random Tuesday, likely while staring at our phone, wondering if we're ever going to escape the hamster wheel. You're sitting at your desk at work, it's Wednesday afternoon, you're in another pointless meeting that could have been an email, your boss is talking about quarterly targets and synergy and other corporate buzzwords that make you want to slam your head against the table. You're not listening, you're doing math in your head. You're thinking, I have $50,000 in my investment account. If the market returns 10% a year, that's $5,000. I make $75,000 at this job, so I'd need, and then you start calculating. When can my investments make more than my salary? When can I tell my boss to shove this job and live off my portfolio? When does the money I've saved finally work harder than I do? You run the numbers. With $50,000 invested, you'd need $1.5 million to replace a $75,000 salary at a 5% withdrawal rate. At your current savings rate of $1,000 a month, accounting for market returns and compound growth, that's going to take 26 years. 26 years! You're 32 years old. That means you're working until you're 58. You close your laptop, you want to scream. You think, there has to be a faster way. There has to be a point where this snowball starts rolling on its own. When does that happen? This is the question that haunts every person who's trying to build wealth. When does investment income finally beat your day job? When do you hit the inflection point where your money is working harder than you are? When does financial independence stop being a fantasy and start being a reality? And here's the most important part that nobody talks about. There's a specific, calculable moment when this happens, and most people have absolutely no idea when that moment is for them. They're just hoping and guessing and assuming it'll happen someday. My name is John, and I have spent an embarrassing amount of time obsessing over compound interest, withdrawal rates, and the exact mathematical point at which investment income surpasses earned income. If you are someone who's trying to build wealth, but you feel like you're running on a treadmill getting nowhere, or if you've been investing for years, but you still feel completely dependent on your paycheck, or if you've ever wondered whether you're even on track to hit financial independence in your lifetime, make sure to hit that subscribe button and give this video a thumbs up. Because today, we're not talking about get-rich-quick schemes or crypto moonshots. We're talking about the actual math behind when your investments start replacing your income, the specific milestones you need to hit, and why most people completely misunderstand how long this actually takes. Let's start with the brutal truth that the financial services industry doesn't want you to fully understand. Investment income beating your day job income doesn't happen gradually. It happens suddenly. It's not a smooth transition. It's an inflection point. For years and years, your investments feel insignificant compared to your salary. You're saving $1,000 a month, your portfolio grows to $30,000, then $50,000, then $100,000, and the returns feel like nothing. Your portfolio makes $8,000 in a good year, and you think, cool, that's nice, but I make $75,000 from my actual job. These investments are barely moving the needle. But then something happens, something incredible and mathematically inevitable. The compound growth curve that's been slowly, painfully building starts to bend upward. Your portfolio hits $300,000, then $500,000, then $750,000. And suddenly, in a good market year, your investments are making $50,000, $60,000, $75,000. You're making as much from your portfolio in a single year as you make from your actual job. And you didn't change anything. You didn't get smarter. You didn't find a secret strategy. You just stayed consistent long enough for compound interest to do what it always does. It accelerates. This is the crossover point, and understanding when it happens for you is the difference between working until you're 70 and retiring at 50, between feeling trapped by your paycheck and feeling free. So let's do the actual math. Let's figure out exactly when investment income beats your day job income for different scenarios. We're going to use real numbers, real withdrawal rates, and real assumptions based on historical market data. No fantasy scenarios, no assuming you'll get 15% returns every year. We're going to be conservative, realistic, and honest. Let's start with a baseline scenario. You make $75,000 a year. That's close to the median household income in the United States. You're saving $1,500 a month, which is 24% of your gross income. That's aggressive, but achievable if you're serious about financial independence. You're investing in a diversified portfolio of index funds. We're going to assume a 7% average annual return, which is conservative based on historical stock market performance after accounting for inflation. Here's what happens year by year. After 1 year, you've contributed $18,000, and with returns, your portfolio is worth about $18,600. Your portfolio made $600. You made $75,000 from your job. The portfolio is 0.8% of your income, irrelevant. After 5 years, you've contributed $90,000 total, and your portfolio is worth about $107,000. Your portfolio made $7,000 that year. You still made $75,000 from work, assuming no raises. The portfolio is now generating 23% of your income. It's starting to matter, but you're still completely dependent on your paycheck. After 15 years, you've contributed $270,000 total, and your portfolio is worth about $448,000. In year 15, your portfolio made about $31,000. You're still making $75,000 from work, assuming no raises. The portfolio is now generating 41% of your income. You're getting close. After 20 years, you've contributed $360,000 total, and your portfolio is worth about $738,000. In year 20, your portfolio made about $52,000. You're making $75,000 from work. The portfolio is generating 69% of your income. After 23 years, you've contributed $414,000 total, and your portfolio is worth about $986,000. In year 23, your portfolio made about $69,000. You're making $75,000 from work. This is the inflection point. Your investments are now generating 92% of your income. So after 25 years, you've contributed $450,000 total, and your portfolio is worth about $1,185,000. In year 25, your portfolio made about $83,000. You're making $75,000 from work. Your investment income has officially beaten your day job income. After 25 years of consistent saving and investing, your money is finally working harder than you are. But here's where it gets really interesting. Once you cross that threshold, the acceleration is insane. After 30 years, your portfolio is worth $2 million, and it's generating $140,000 a year. That's almost double your salary. After 35 years, your portfolio is worth $3.2 million, and it's generating $224,000 a year. That's 3 times your salary. This is the power of compound interest that nobody truly grasps until they see it happen. For the first 15 years, it feels like you're getting nowhere. Your investments are making pocket change compared to your salary. But if you stay consistent, if you keep contributing, if you don't panic and sell during the downturns, there's a moment, usually somewhere between year 20 and year 25, where everything changes. Your investments stop being a side thing and become the main thing. Now, 25 years sounds like forever. You're probably thinking, John, I don't want to wait 25 years. That's half my working life. There has to be a way to speed this up. And you're right, there is. There are several ways to hit the crossover point faster, and we need to talk about all of them. The first and most obvious way is to increase your savings rate. Let's run the same scenario, but instead of saving $1,500 a month, you save $3,000 a month. That's 48% of a $75,000 salary, which is extremely aggressive, but possible if you live well below your means, have a side hustle, or have a partner contributing to household expenses. With $3,000 a month invested at 7% annual returns, after 10 years, your portfolio is worth $496,000, and it made about $35,000 that year. After 15 years, your portfolio is worth $897,000, and it made about $63,000 that year. After 17 years, your portfolio is worth about $1.1 million, and it made about $77,000 that year. You've hit the crossover point. By doubling your savings rate, you cut the timeline from 25 years to 17 years. You shaved 8 years off your working career. This is why the FIRE movement, financial independence, retire early, is so obsessed with savings rate. Savings rate is the single biggest lever you can pull to accelerate your path to financial independence. Every percentage point you increase your savings rate dramatically reduces the number of years you need to work. The second way to hit the crossover point faster is to increase your income while keeping your expenses flat. This is called lifestyle arbitrage, and it's incredibly powerful. Let's say you start at $75,000 a year, saving $1,500 a month. But over 10 years, through job changes, promotions, and side hustles, you increase your income to $120,000 a year, while keeping your expenses at the same $57,000 a year. Now you're saving $5,000 a month instead of $1,500. With that accelerating savings rate, you hit the crossover point in about 14 years instead of 25. You cut 11 years off the timeline. This is why the advice to earn more is actually more powerful than the advice to spend less, even though both matter. There's a limit to how much you can cut expenses, but there's theoretically no limit to how much you can earn. The third way, and this one is controversial, is to take on more risk to potentially achieve higher returns. If instead of averaging 7% annually, you average 10% annually through more aggressive stock allocation, more concentrated positions, or alternative investments, the timeline compresses dramatically. At $1,500 a month with 10% returns, you hit the crossover point in about 19 years instead of 25. That's 6 years saved. But here's the critical thing that everyone needs to understand about this approach. Higher returns come with higher volatility. You might hit the crossover point faster, or you might lose 40% of your portfolio in a market crash and set yourself back 5 years. Risk is a double-edged sword. I'm not saying don't take risks. I'm saying understand the trade-offs. The fourth way is to reduce the income you need to replace. This sounds counterintuitive, but it's actually one of the most powerful strategies. If you make $75,000, but you live on $50,000, you don't actually need to replace $75,000 of income. You need to replace $50,000. And here's where the math gets beautiful. To replace $50,000 of income using the 4% rule, a conservative withdrawal rate based on the Trinity study, you need $1.25 million. To replace $75,000 of income, you need $1.875 million. That's a difference of $625,000. That's multiple years of working. By living on less, you not only save more money faster, but you also reduce the target finish line. You're running toward a closer goal while running faster. It's the ultimate optimization. Now let's talk about something that most financial advisors don't emphasize enough: the psychological shift that happens at the crossover point. When your investment income finally exceeds your day job income, something changes in your brain. Work stops feeling mandatory. It starts feeling optional. And that shift, that psychological freedom, changes everything. You start making different decisions. You stop tolerating toxic bosses because you know you don't need this job. You start negotiating harder for raises because you're willing to walk away. You start taking more career risks because you have a safety net. You might start your own business or take a lower-paying job that you actually enjoy, or negotiate for part-time work, or take a year off to travel. The crossover point isn't retirement. Most people don't quit working the moment their investment income exceeds their salary, but it's the moment you gain optionality. It's the moment you start working because you want to, not because you have to. And that's the real definition of financial independence. Here's something else that nobody talks about. The crossover point is different for different types of income. There's passive investment income from index funds, which we've been discussing. But there's also dividend income, rental income, business income, and royalty income. Each of these has different tax implications, different risk profiles, and different timelines. Dividend income, for example, can provide cash flow earlier than total portfolio returns. If you build a portfolio of dividend-paying stocks yielding 4%, a $500,000 portfolio generates $20,000 a year in actual cash that hits your bank account. You don't have to sell anything. You don't have to worry about sequence of returns risk. The cash just shows up. Rental income can provide cash flow even earlier if you use leverage. A $400,000 rental property that you bought with a $100,000 down payment might generate $12,000 a year in positive cash flow after all expenses. That's a 12% cash-on-cash return on your down payment. If you buy 3 properties over 10 years, you might have $36,000 a year in rental income from $300,000 of invested capital. That's real, tangible income that can replace a significant portion of your salary much faster than waiting for your index funds to compound. Now, business income is the fastest way to hit the crossover point, but it's also the riskiest and most labor-intensive. If you build a business that generates $100,000 a year in profit, and you can step back from day-to-day operations while maintaining 70% of that income, you've created $70,000 a year in semi-passive income. That might take 5 years to build instead of 25, but it requires entrepreneurial skill, risk tolerance, and usually a lot of failure before you succeed. The point is this: there's no single path to the crossover point. The question isn't just, when will my investments beat my day job? It's, which combination of income streams will get me to financial independence fastest, given my skills, risk tolerance, and life situation? Let me give you some real-world examples of people who hit the crossover point at different stages and through different methods, because the theory is useless without seeing how it actually plays out in real life. Case 1. Sarah, the corporate grinder. Sarah worked in tech sales, making $120,000 a year. She lived in a low-cost-of-living city, shared a house with roommates, and saved 60% of her income. That's $72,000 a year. She invested everything in broad index funds. After 12 years, she had about $1.3 million. At 7% returns, that's generating about $91,000 a year. She hit the crossover point at age 34. She quit her corporate job and now does consulting work that she actually enjoys, working about 20 hours a week. Case 2, Mike, the real estate investor. Mike was a teacher making $50,000 a year. He couldn't save much, maybe $400 a month, but he house hacked, living in one unit of a duplex and renting out the other. Every few years, he bought another property. After 15 years, he owned 5 rental properties that generated a combined $42,000 a year in net cash flow. He hit the crossover point at age 42, not through stock market returns, but through real estate leverage and forced appreciation. He's still teaching because he loves it, but he doesn't need to. Business Case 3. Jennifer, the business builder. Jennifer worked a corporate job making $85,000 but hated it. She started a blog as a side hustle. After 3 years of working nights and weekends, the blog was generating $4,000 a month through ads, affiliates, and sponsored content. After 5 years, it was making $8,000 a month. She quit her job. She hit the crossover point in 5 years, but she traded evenings and weekends for those 5 years. Her portfolio was small, only about $80,000, because all her extra money went into building the business, but her business income replaced her salary in a fraction of the time. Each of these people hit the crossover point, but they did it differently. Sarah maximized savings rate and let compound interest do the work. Mike used leverage and built equity. Jennifer built a cash-flowing asset. There's no single right answer. Now let's talk about the mistakes people make when trying to hit the crossover point, because there are specific, predictable ways that people sabotage themselves on this journey. Mistake number 1, changing the goalpost. You start with a goal of replacing $60,000 of income. You save and invest for 10 years. You get close. But now you're making $100,000 and you've inflated your lifestyle. Suddenly, you need to replace $100,000 instead of $60,000. You've pushed the finish line back. This is called lifestyle inflation, and it's the silent killer of financial independence. Every time you increase your spending, you increase the amount of wealth you need to generate. The only way to win is to lock in your lifestyle at a level you're comfortable with and never inflate it, no matter how much your income grows. Mistake number 2, panicking during downturns. The market crashes, your portfolio drops 30%. You had $800,000 and now you have $560,000. You feel like you just lost 5 years of progress. You panic and sell, or you stop contributing, or you pull money out for emergencies. You've destroyed the compound interest curve. The people who hit the crossover point are the ones who keep contributing through the crashes, who buy more when everything is on sale, who understand that volatility is the price you pay for long-term returns. Mistake number 3, comparing yourself to others and making stupid decisions. You see people on YouTube claiming they retired at 30 with crypto or day trading or some other high-risk strategy. You abandon your boring index fund plan and chase returns. You lose money. You set yourself back. The path to the crossover point is boring. It's consistent saving, diversified investing, and patience. Anyone selling you a shortcut is lying to you or got lucky and is confusing luck with skill. Mistake number 4, not adjusting for taxes. You calculate that you need $60,000 a year to live on, so you need a $1.5 million portfolio at a 4% withdrawal rate. But you forgot about taxes. If all your money is in a traditional 401k, you're paying income tax on every dollar you withdraw. You actually need more like $75,000 of withdrawals to net $60,000 after taxes, which means you need $1.875 million, not $1.5 million. Always, always, always factor in taxes when calculating your crossover point. So how do you actually track your progress toward the crossover point? How do you know if you're on track or falling behind? Here's a simple framework. Calculate your FI number, that's the amount of money you need invested to replace your income using the 4% rule. If you need $60,000 a year, your FI number is $1.5 million. That's your target. Calculate your current FI percentage, divide your current net worth by your FI number. If you have $300,000 and your FI number is $1.5 million, you're at 20% FI. You're 20% of the way to financial independence. Track your FI percentage every quarter. You should see it increase steadily. If it's not increasing, something is wrong. You're either not saving enough, your investments are underperforming, or you're inflating your lifestyle. Celebrate the milestones. When you hit 25% FI, celebrate. You're a quarter of the way there. When you hit 50% FI, that's a huge milestone. You're halfway to never needing a paycheck again. When you hit 75% FI, you're in the home stretch. And when you hit 100% FI, you've reached the crossover point. Your investments can now sustain your lifestyle indefinitely. Here's the truth that the financial industry doesn't want you to fully internalize. Hitting the crossover point is not about luck. It's not about being smart. It's not about timing the market or finding the perfect investment. It's about math. It's about consistently saving a high percentage of your income and investing it in assets that compound over time. That's it. That's the whole game. If you save 50% of your income and invest it at 7% returns, you'll hit financial independence in about 16 years, regardless of how much money you make. If you save 20% of your income, it'll take about 37 years. These numbers are mathematical certainties based on compound interest. The only variables are your savings rate and your returns. The crossover point, the moment when your investment income finally beats your day job, is not some distant fantasy. It's a calculable, achievable milestone that you can reach in your lifetime if you understand the math and stay disciplined. For most people, it takes 20 to 25 years with a moderate savings rate. If you're aggressive, you can do it in 15 years. If you're extremely aggressive and optimize everything, you can do it in 10. But here's what matters. You have to start. You have to contribute consistently. You have to ignore the noise. You have to stay invested through the crashes, and you have to resist lifestyle inflation. If you do those things, there will come a day, probably sooner than you think, where you'll look at your investment account and realize it made more money last year than your job paid you. And on that day, everything changes. If this video made you realize exactly how far you are from the crossover point, or if it gave you hope that it's actually achievable, share it with someone who's trying to build wealth but feels stuck. We need more people to understand that financial independence isn't just for the rich, it's for anyone willing to live below their means and let compound interest do the work. Thanks for watching The Penny Plan, and I'll see you in the next one. If you